Hey, this is Justin from BreakIntoCRE.com, and in today's video, we're going to talk about the 4 main strategies that commercial real estate investors use to buy profitable real estate deals. So if you want a better idea of the different ways you can actually make money buying commercial real estate deals, make sure to stick around for this video. Now, if you're new here on this channel, we talk about real estate investing careers and real estate financial analysis. So if you're looking to break into the commercial real estate industry or do your first commercial real estate deal, make sure to subscribe and hit that notification bell. So commercial real estate properties aren't cheap. And oftentimes to buy commercial real estate properties, investors need to raise capital from outside equity investors in order to capitalize the deal, pay for the acquisition, and ultimately execute on any sort of business plan they have to add value to the property. And at the end of the day, since commercial real estate investors invest in these properties to make money, what are the different ways that they actually make money doing this? Well, in this video, I wanted to break down 4 of the most common ways that commercial real estate investors make money and the strategies they use for each. So let's start this off with strategy number 1. And this strategy is probably the most common and the one that you're going to be most familiar with, and that is the value add through renovation strategy. Now, this is your typical rehab on an older property. So for an apartment complex, you may be renovating common areas and also renovating unit interiors. And for a commercial property, you may be renovating hallways, lobbies, building exteriors, and other shared spaces that are going to help you command higher rental premiums at that property. This is one of the most commonly used strategies in multifamily, since it makes sense and is relatively straightforward that an apartment renter would pay more money for a nicer living space and nicer amenities as well. On commercial properties, so retail, office, and industrial, this is still very relevant as far as the common areas are concerned, but within the tenant suite specifically, oftentimes a landlord isn't going to be doing a full build out similar to what they'd be doing on a multifamily unit, making this strategy slightly less relevant to commercial real estate interior suites. Now, sometimes a major value add renovation isn't even necessary to increase rents and add value to the property. And this leads me to strategy number 2, which is the mark-to-market or lease-up play. And the mark-to-market or lease-up play essentially involves buying a property that has below market rents relative to the location or age of that property, or buying a property with below market occupancy rates with the intention to raise occupancy and raise net operating income through increasing revenue. So for a multifamily deal, a mark-to-market play might look like buying an older multifamily property that's been 100% occupied for years because maybe an older owner wants to keep that property at 100% occupancy, and to do that, that landlord has chosen not to raise rents for 1 to 2 years or more. This allows investors to come into the property and raise rents to market rates upon lease expirations and either renew at that existing rate or find a new tenant that is willing to pay market rates for that unit. Now, for a commercial deal, since leases are generally longer in term, this might look like buying a property with 1 or more large tenants at that property at below market rates, with lease expirations coming up 1, 2, or 3 years down the road, where at that point you either have the option to renew the lease with the current tenant at market rates, or you can release that space to a new tenant at market rates as well and raise net operating income that way. And for the lease-up strategy on commercial properties, this could mean buying a property that's only 40% occupied with the intent to lease up the remaining 60% to 1 or 2 tenants within the first 6 to 9 months of ownership. Either way, these methods allow investors to quickly increase net operating income, and since commercial real estate and multifamily properties are valued based on their income that they can generate, quickly increase the value of those properties as well. Now, strategy number 3 in commercial real estate is the land bank or covered land play. Now, the land bank approach essentially involves an investor going out and buying a well-located piece of raw land, either to sell in the future or to develop in the future, with no set date for when they're actually going to develop the property or sell the land. Now, these properties are usually acquired in areas where there's expected to be quite a bit of appreciation over the next few years, or in urban infill locations where there's lots of development going on those surrounding parcels. Now, by investing in a developing area, this gives the investor maximum optionality when they either decide to develop the property or they decide to sell the property to a developer that wants to build a structure on that land. Now, the covered land play is very similar to this, except on a covered land play, you're generally buying an existing older building that's going to be generating some sort of rental revenue that will generally offset the expenses of owning that property. So the covered part of the covered land play is essentially that the property and the tenants that are in that property are going to cover your expenses, so you're able to own the property without having to pay out-of-pocket expenses for property taxes, insurance, and any other expenses that come up on the deal. Now, this strategy is great for investors who are willing to bet on appreciation and don't need the cash flow from their investment on day one. And speaking of cash flow, strategy number 4 is to buy a stabilized cash flowing property and to hold that property indefinitely. Now, this is generally a strategy used by smaller individual investors looking for retirement income rather than private equity or institutional investors who generally hold properties on a shorter term basis. So because most real estate private equity firms are highly compensated based on the amount of transaction volume that they do, and ultimately when they sell properties for a gain and participate in that profit share, most of these companies will only hold the property for about 3 to 7 years before selling. That said, for the individual investor who is looking to produce some sort of an income stream and hold the property for the long term, this can be a great strategy to do that. So there you have it. Those are 4 of the most commonly used commercial real estate investing strategies that you'll see in commercial real estate today. Now, if you want to learn more about commercial real estate investing strategies and how these are actually applied in commercial real estate deals, definitely check out my course, Commercial Real Estate Investing 101, and I'll link that in the description below. So I hope that was helpful. If you like this video and want to see more content like this, make sure to let me know by hitting that like button, subscribe to the channel, and share this with anyone else who might find this helpful. Thanks so much for watching, and I'll see you in the next video.